Welcome to the first mini lecture for Chapter 1. And the notes that I am using here, you can access and print out or just look at on the computer by going to the Chapter 1 folder in Blackboard. We're going to begin our study of Chapter 1 by looking at the various organizational forms. And there are other forms, but these are the three primary ways businesses can be organized. The first is sole proprietorship, and the word sole means one. These are businesses owned and operated by one individual. And if we look at page 5 in our textbook, the purple section here represents the percent of businesses owned as sole proprietorships, 72%. And the reason why that form of business is so popular is that it's very easy to form with no special legal maneuvers, as our notes indicate. In other words, to start a business, you would go to the county building in either Erie or Niagara County, wherever you reside, and you would ask for a DBA form, a doing business as form. And that would establish the legal operational name of your business. If you decide to hire employees, you'll also need an employee identification number, and you would go to the federal government for that. And if the services or products that you sell are taxable, you would also need a sales tax ID number, which you could apply to New York State for. And that's about it. You could then open your doors and begin operating. You would not need the services of an attorney to draft any special agreements or to get started. An upside of the proprietorship is that you get to keep all the profits or the losses. You run the business and you can make all decisions. You also can report the profits of the business on your personal tax return, which gives you a lower rate of taxation than a corporation, for example. The downside is that you run the business all by yourself. You're limited by your time and resources. And also you're bearing all those losses. Here's another downside in D. The owner is personally liable for all debts of the business. That's called unlimited liability. And that means the owner is personally liable for loans that they take out for the business. They're also personally liable if the business gets sued by a customer, for example, for an injury that might have occurred on the premises or through use of a product. If the owner loses the lawsuit, then the owner is personally liable for any debts arising from that lawsuit. So they could come and take the owner's boat or the owner's car in order to satisfy that debt. A judgment could be issued. Now in number 2, a partnership is very similar to a sole proprietorship, except that we've got more than one person. So we've got more resources, we've got more brain power, more money, more effort available to help run and grow the business. And the profits and taxes and liability would be split between the owners, so that would be 2 or more people owning the business. We would still report any profits on the individual partner's personal tax returns, so you're still enjoying that lower rate of taxation. But it's a little more expensive to form than a sole proprietorship because you have to go to an attorney to draft that partnership agreement. And that agreement would specify how much of the profits each of the individual partners would get to take out of the business, and what would happen upon dissolution of the business, how they would split any remaining resources, that type of thing. A key advantage is that by having more owners, you've got more resources available. However, you still have unlimited liability. The individual partners are jointly and severally liable. That means that if money is owed, whether it's from a lawsuit or a loan or any type of debt, the creditor can come and try to satisfy his debt to any one of the partners or all of the partners. and they are personally liable, as in a sole proprietorship, which means their personal resources can be taken to satisfy the debt. With corporations, a corporation is a separate legal entity from both a legal and accounting perspective. Let's take a look here again at our chart, pie chart here. We said sole proprietorships represent 72% of businesses organized. Partnerships are this little red 4% here, and corporations are 18% of business organizations. However, they generate the vast majority of revenues earned in the United States. The corporation, not its owners, are legally responsible for taxes and debts, so the owners cannot lose more than their investment. That's called limited liability, and the owners of corporations are the stockholders. So if you own a share of stock, you're an owner of a corporation, and you are not personally liable for the debts of the corporation. The most you could lose is your original investments. The corporation, not its owners, are legally responsible for taxes and for debts. Now, two disadvantages of the corporation format are the legal fees for creating the corporation, because they can be expensive. You have to go to an attorney. And also, because a corporation is a separate legal entity, they pay their own taxes. So the corporation pays its taxes, and then you as an owner, if you receive a share of the profits, which is called a dividend, you get taxed on that dividend. On the other hand, corporations can raise large amounts of money because when they need to raise money, they can simply issue more stock, include more owners, and then raise money that way. Now, a corporation can either be private or public. A private corporation would not make its stock available to the public. A public company would make its stock available to the public, and you could buy that on a stock exchange. Okay, now let's talk about accounting for business decisions. Oh, I'm sorry, I forgot to mention here. If you want to learn more about starting a business or the business organizational forms, the Small Business Development Corporation has a location on our campus at NCCC in Sanborn, as well as in Niagara Falls. And they have folks there that will help you set up a business and know the steps and how to do so. And that's sponsored through the Small Business Administration. There's a website called sba.gov that provides lots of information about that type of thing. Okay, so let's talk about why accounting is important. We're going to be studying companies that are in business to make money. We call those for-profit corporations. Not-for-profit companies would be things like churches and schools and the Red Cross. They're in business to provide a service. But we're going to be learning about businesses that exist to earn profit for their owners, and they sell products or services to do so. But all businesses, whether they're for-profit or not-for-profit, need to have an accounting system. An accounting system's goal is to capture information about the operations of the business, about the investing activities, about the financing activities of that company, in order to help make decisions about that company. Because accounting isn't really math. We hear often people say, oh, accounting is too much math. It's really not math. We use math, but it's really an information system designed by the organization to capture those activities. And to capture them, we analyze them and we record them, and then we summarize and report those activities about the financial condition and performance of the business in order to help make decisions, both inside and outside of the organization. Sometimes we use the word internal for inside the business and external to represent those who are outside of the organization. Now let's talk about that accounting system. I'm going to a little colored graph here which will be a little bit more interesting to look at than the black and white text. And this kind of represents the accounting information system. A business engages in operating, investing, and financing activities, and then those activities are captured by the accounting system. And we said that means that they're analyzed, recorded by the system. And then accounting reports are prepared. Now, this semester you're studying financial accounting, which is geared toward providing information to those who are outside the business or external to the business. And then that information is used to evaluate the company's operations and their investing and their financing activities. In Accounting 117, or Managerial Accounting, you'll be learning about the reports that are prepared to help people within the business make decisions. Managers, supervisors, those involving production and marketing and human resources, etc., to help them run their business, to engage in the best operating, investing, and financing activities. So this semester we'll be focusing on the financial reports. So who uses those types of reports? Okay, so we've got creditors, and creditors represent people that the company owes money to. And why will they be interested, and how will they use these reports? Well, they're going to be wondering if the company has enough cash to make payments on the loan. Or perhaps banks might be wondering whether they should give them the loan, so they'll ask for those accounting reports in order to make a decision to give them a loan or not. And we're going to be learning these words in the very next lecture. Does the company have enough assets or resources to cover its liabilities, which means their debts? Investors are people who intend to or have already invested in the business or intend to invest in the business. They could be potential stockholders. And they're going to be wondering, am I going to get a return on my investment? If it's a corporation, we call that a dividend. Or they're wondering if there's going to be an increase in stock value over the course of that period, so they're going to want to look at those accounting reports as well. The people who run the business, the directors of the business, are going to wonder if the company is using its resources wisely. Are the company's managers making decisions that are in the best interest of the stockholders, the owners? Is the company achieving their business plans and their goals? Are they earning a profit? Those would all be concerns of those who are directing the company. And of course, the government is always there. The Securities and Exchange Commission is going to wonder if it's a corporation, whether they're following the rules. The IRS, well, they're going to want their tax money, correct? Now, this semester, we're going to be focusing on the corporate form of business organization. However, all the rules that you're learning will be the same for a sole proprietorship or partnership, except for the portion that deals with the owner's interest. Because the owners are the stockholders in a corporation, they're the partners in a partnership, and they're the single or sole owner if it's a partner, or if it's a sole proprietorship. Okay, so I believe we already spoke about all of these. So we're at the end of our first mini lecture. Our next mini lecture is going to be super important, and that deals with the basic accounting equation.